and the first rates actually will start kicking in any second now. You got Nifty, which is off to a flat start. You've got Bank Nifty, which is off to a flat start with a negative bias. I'll just use my screen for reference purpose, just to see where the big changes are there in terms of the price action. In the volume action now, you got, I think there is a large block deal in Home First Finance. We're telling you about Gokuldas Exports, that block deal is done. So 2 blocks, Home First Finance and Gokuldas Exports, they both are done. You got Yes Bank, which is off to a flat start, but sugar stocks are really, rocketing up. Bajaj Hindustan, the company ran into rough weather with the lenders, and when the rally in sugar is strong, Bajaj Hindustan is also jumping on the bandwagon. 7% higher for Bajaj Hindustan. Reliance Power is looking strong, PC Jeweler is looking strong, Adani Wilmar is up, NCC is up. So while you can look at the index and say dhila hai, nothing happening, no large price action, but the breadth is charged up. Ranked mid-cap stocks which are patronized by dealers, by traders, that's looking strong. And if I just have to hunt for the price action purely based on the first rates, 2 block deals. Reliance is looking strong in terms of volume action. And then what else is catching my attention? I think it's Shriram Finance, where the volumes are looking strong again. Aisha?
Yeah, those are a couple of stocks which are in focus. Shriram Finance, Kirloskar Oil, like we just told you, wherein the Kulkarni family and the promoter group has sold 13%. Mutual funds are said to have been buyers. That stock is holding up in the green as we speak right now. And Shriram Finance as well, wherein PE investor Apex has sold, and Capital International, which is a large buyer in block deals. So these are a couple of stocks which are in focus. Let's see what Stop also is up to. Considering the same store consumption has been pretty high, and now they're going to be in a strategic distribution partnership with Japanese company Shiseido as well. So that's another stock in focus. Bharat Forge too, which has announced their e-bike manufacturing facility at Chakan in Pune. That's another stock in focus. Data Patterns, wherein the QIP, as we understand, has opened. That stock holding up 0.6%. And then Gokuldas Exports as well, wherein the promoter Clear Wealth Consultancy is looking to sell 8.25% stake via block deals. That's another stock in focus as well. Let's see whether the sugar and defense trade still is continuing or not. Remember, yesterday both HAL and Balrampur Chini were big winners in trade. Balrampur Chini has settled in flat right now. Bajaj Hindustan looking up, and let's just get the entire pack going as well. I think it's a very sporadic move today, but Hindustan Aeronautics, after that 5.5% jump, let's see what that stock is up to. And then Hindustan Bank as well, considering the big breakout on that stock yesterday and the fact that it held out by nearly 4.5% today, it's a lot tempered. But Kunal, it's such a flat start. Where does it go next?
Yeah, I think it's as per expectations, because I frankly expected that the markets would probably remain more flattish. The volatility index as well has gone down to sub the 30-odd mark, so that again would probably put the indices into a bit of a tight range. The stock which I would look to trade on the opening would be Hindustan Bank, specifically after yesterday's price action move, where the stock came back about 1170 mark. So I think any 10-20 rupee dip, 1150-60 mark, I think is a very good zone to try and buy the stock.
That's Hindustan Bank for you, getting Kunal's stamp of approval. Meanwhile, just keep an eye out on the screen. We've been talking about a whole host of block deals as well that are taking place, the details of which are on your screen. We got you that exclusive as well of the Gokuldas Export block deal, and there has been a 10% change of equity. Meantime, Naresh, let's get in your first trade.
So that's a buy on Indian Energy Exchange. The stock has given a breakout and continues to do so. Today also closing above yesterday's high, that 149 mark. So expecting this to continue slowly towards 170.
Okay. Ashwini Agrawal joins us. Let's connect with him, understand what his current market view is, where is he investing, and what does he make of what's happening in terms of this entire Adani group of stocks and the news there. Ashwini, good morning. Thank you for joining us. It's a new backdrop. You're not joining us from your office?
Yes.
No, I'm saying it's a new place. Looks like you're joining us from.
Yeah, this is my office. This is my office that I recently opened at Kohinoor Square in Dadar.
Okay, congratulations.
Thank you.
It's been a hard year to call. Lot of news, lot of views. What do you make of the volume, the news flow and the market action so far for this year?
So I think, we started off the year with negative news flow on foreign flows. Basically, India was the only game in town through 2022. And at the start of the year, we started to see other emerging markets look more attractive, which kind of continued the pressure on foreign selling, which was visible for much of 22 as well, except for the last quarter or so. And then we saw that resume at the start of the year. And then, of course, you had the episode of the Hindenburg report on Adani Group, which caused a massive risk off in terms of sentiment insofar as India is concerned. So these two events combined, plus the fact that India's demand is slowing down, earnings growth is kind of ho-hum, didn't really leave any room for excitement. So that kind of caused the sort of weak sentiment and lack of interest among market participants over the last 2.5 months. As we look forward into the rest of the year, the way I think about it is that hopefully at some point in time during the year, we'll start to see an end of the rate hiking cycle that we've been into over the last year or so. And hopefully with growth expectations also moderating, we will get into the situation where growth starts to meet expectations in terms of earnings growth. And the extraordinary amount of capital expenditure that the government is putting into the ground starts to have a knock-on effect on aggregate demand. So that's what I'm hoping to see as the year goes forward. But obviously, it's been kind of a very, very not difficult, I would say, but very lackluster year so far.
In your understanding, do you think the impact what markets had when they were feeling the heat because of the sell-off in Adani Group of stocks, whether it was infra names or lenders or NBFCs, is that behind us? Is that price adjustment behind us?
Yes, I think so. I think the whole episode which led to the sell-off in the banks and weakness in the sentiment is now behind us. Partly because I think, all the financial companies and banks that are lenders to the group kept reiterating that at least insofar as the operating companies are concerned, the operating cash flows are sufficient to cover the debt. Now, I'm not invested in any of these companies, so I don't have any first-hand knowledge on what the indebtedness, etc., looks like. But if I accept that at face value, and then you look at the GQG transaction that happened last week, it appears that at least for the moment, the group has enough cash flows to be able to meet its obligations. Whether in the near term we will see more sell down from them or any specific asset sale, it's hard to tell. But I would imagine that given the steep fall in stock prices of the group and given the cash raise that happened last week, insofar as the market is concerned, this is no longer an overhang. That would be my take.
But Ashwini, just wanted to understand whether the Adani saga episode has sort of put a new lens to leveraged groups in the market. I mean, without naming a few, is the market now going to be circumspect of highly leveraged balance sheets?
Well, Aisha, that's been the case for the last 10 years. I mean, since you brought this up, and I was just reading this morning an article on the appointment of Ashish Gupta as the CIO of Axis Mutual Fund and how he shot to fame with his House of Debt report in 2012. If you go back over the last decade, debt has been a dirty word pretty much all through. And I think the market has been very, very careful about investing in companies which have a lot of debt. So I don't think there's an incremental change to that perception. And I wouldn't say that over the last two years or so of the rally that we saw post-COVID, that the market became a little bit cavalier in terms of how it looked at debt-oriented companies. So I don't think there's a change there, frankly.
A lot of analyst reports have also come out which are now talking about, okay, banks, great sector to be in. The best perhaps is behind us because interest rates are high, NIMs will come under pressure, and peak of the profitability is behind us. Do you think best of the run-up in banks is over?
Great question, Nikunj, because I've been wondering about that too. But let's take the three pieces that you spoke about. Let's first talk about rates going up and NIMs. Insofar as the results for the December quarter are concerned, there is no pressure on NIMs. And if you look at the outlook that has been presented by most of the banks after the December quarter results, they do not indicate any pressure on NIMs either. Bulk of the loan book is floating in nature, and some of the FDs are kind of fixed in nature. So in a rising rate cycle, the near-term NIMs don't see much of a pressure. That's obviously evident in the numbers that we see in the December quarter, and that's coming through in the commentary for the March quarter as well. So I don't think NIMs are going to be under pressure right now. In terms of credit costs, yes, you're right. In terms of operating expenses and credit costs, a lot of the good work done over the last 4 or 5 years is now finally showing through for the last 3 or 4 quarters. But my sense is that write-backs are still not in. And that may be a source of positive earnings surprises as we go ahead. There is a lot of chatter about difficult resolutions, making some headway. So let's hope and see what comes through. So putting this together, is the best of the rally in the banks is done? The answer probably percentage terms is yes. But will you see more upside in the banks? My take would be yes. You will see more upside because I think the earnings growth is still going to be quite robust. Balance sheets are starting to grow. So you're seeing loans growth in mid-teens for most of the banks. So earnings growth is going to be very, very good. And if you look at long-term valuations, many of the banks are still trading at below median valuations from a long-term historical perspective. And one of the things that I've kind of figured out over a period of time, or at least that's what I think, is that no sector tops out till it starts trading well above the median, in terms of valuation. So I don't think the valuations are excessive just yet. So that's what gives me hope. But yeah, you're right. You're not going to see multi-baggers from here. But will you see still some price action? And is this still good place to invest in? And I think so.
Ashwini, morning. Wanted to get in your take on the telecom space as a whole, because yes, we are seeing a lot of faster data, a lot more mobile penetration. What about some of the headwinds for these companies, like reduced profitability or high debt? Is that a concern?
Not to my mind. I mean, I think the stability in market shares between the two leading players and the small steps being taken to raise prices at the bottom of the pyramid, the rollout of the 5G services, which obviously will lead to a switchover at the top end of the pyramid. These are all factors that should help earnings as we go along. Also, I mean, I'm just thinking and reading about the news reports where the regulator is talking about OTT players having to share some of the revenues with the telcos. I don't know what will finally come through, but it can be something better than zero, which is the case right now. So that might be another leg up. So it's a consistent earnings growth story. And valuations are kind of okay. They're not super expensive. So I'm hoping that there is a little more legroom here for the stock prices to move.
Ashwini, what about infrastructure? Because anyone and everyone that you speak with is definitely bullish on this space. Is it now getting to that overcrowded trade, or do you think valuations are still pretty lucrative?
Infrastructure is a difficult one. If you look at construction companies and provider of infrastructure services, I mean, this is a deeply cyclical business with huge payment issues and receivables in the past. So I'm kind of very wary to invest in this area. Insofar as infrastructure owners are concerned, again, if you go back in history and see how many of them have made money for investors on a consistent basis, the answers are very, very difficult. Yes, it's a growth area which is driven by government investment, and hopefully it will drive the economy. But does it mean that the stock market will make you money because of infrastructure? Probably not directly, maybe indirectly through machinery manufacturers and overall aggregate demand picking up. That would be the way I would look at it. I'm kind of staying away from the infrastructure space by and large.
All right, appreciate your time. Thanks so much for joining in and sharing with us your thoughts on the markets. Just a quick revisit and where we're currently at around the 17,730 mark. The broader markets today are showing you a little more fervor compared to the frontliners. You've got those block deals as well that have taken place. So Gokuldas Exports merits a mention. Do remember we got you that exclusive source-based news that Clear Wealth is likely to sell their stake in a Gokuldas Exports. That stock in the spotlight after you did have a block deal. But moving right on then, while he likes the India story and is making a base bet on infrastructure, GQG Partners Rajiv Jain is not so upbeat about new age tech. Let's listen into why.
If you look at the profitability expectations that these companies had, they are being cut pretty aggressively. And the reason is some of these businesses have really no barriers to entry. So the growth is fine, but is this sustainable long-term growth? And one of the things we look for all the time is what are the barriers to entry? Can somebody else replicate those businesses? And at this point, there's no evidence that these are truly businesses that have any pricing power or sort of barriers which can make it difficult for others to come in. So the valuations are still on expensive side for what they're delivering. But I mean, I'm not saying people can't make money. As they say, there are 100 ways to heaven. You just need to find one. But from our cup of tea, they're just better fishes to fry in some of the other areas.
Mr. Jain, every market follows a cycle, and there's always a theme which is at play. So in 2000, it was TMT. Then it was infra between 2003 and 2008. Then good old consumer stocks, which you bought aggressively, the HULs and the Nestles of the world. Can I say that looking at your portfolio positioning in India, you are betting on the infrastructure boom for next 3 to 5 years?
Look, I think we are pretty bullish on that because I think there are a lot of things in place because the execution under this administration has been strong, which is important here. And the second part is that we saw the similar in China in that stage of development where the infra spend actually took off in a big way almost 25 years ago. So we feel that India might be in a similar sort of setup where the earnings growth could accelerate. The problem is there are only few and far names in the infra side, right? Quality names, they're not dime a dozen. Like banks, there are a lot of names you can play. If you look at consumer staples, there are a lot of names, but infra side there's a little bit dearth of those. I mean, the ABB Siemens are just too expensive, and people kind of gravitate toward those. But I agree that I think if I take a 5+ year view, which is what we take, none of what we do is sort of on a short-term basis. I think infra we feel is a lot better place to be. And in general, foreign investors are totally missing in that space, by the way. IT services, pharma, or especially consumer staples is kind of a what I call comfort zone.
Why have you avoided IT companies? I mean, these companies are now doing buybacks, they're doing dividend. Yes, growth is something which changes the terminal value, but ultimately growth is something which these companies are still growing between 8 to 10%.
Yeah, I mean, as I said, I think if I can buy 15% plus growth, why would I buy 8-10%?
Fair point.
And by the way, another mini crisis. If you remember, Infosys, we actually bought quite a bit. There was a whistleblower crisis in Infosys in 2019, not that long ago, right? Down 30% matter of days, hell was breaking loose, and I don't think so many people remember that. So that's these mini crises happen from time to time.
What else is on Rajiv Jain's radar? I'm looking at his excitement and the zing in his voice and his commitment towards India. I'm sure he will not just at Adani.
Yeah, so I think look, we run concentrated portfolios. So we need sort of larger cap side. We can't really operate in mid and small. There are a lot of interesting stuff which we sort of look once in a while, but I think from a larger cap size, these are some of the names that we talked about, and I think our view is that any meaningful pullbacks in some of these kind of names, we probably would be happy buyers. I mean, obviously it depends on the relative opportunity of other places. So I mean, as a matter of fact, if you look at the reopening excitement in China, we haven't really participated at all. In fact, I was wondering why people getting excited about reopening. I mean, nobody expected China to be closed for 5 years, did they? So I mean, like, why is reopening exciting at all? I think the longer term EPS growth story in some of these kind of names is pretty powerful. But you also have to look at a disconnect, right? So and I think the disconnect is some of the areas that I talked about.
Mr. N. Kamakodi, Managing Director and CEO with City Union Bank, now joins us. Let's understand from him that, well, the bank has appointed a new CRO, that is Chief Risk Officer. What is the thought behind this? How does this change some concerns which have been raised by the regulator in the past? And is this an indication from the bank that they are now going to be really taking very cautious steps in terms of their credit profile going forward? Mr. Kamakodi, good morning. Thank you for joining us. Appointment of a CRO, that is Chief Risk Officer. Is this largely after the Reserve Bank of India red flag? Is this an extension of perhaps what Reserve Bank of India wanted and you pretty much have followed their instructions?
It is basically like we felt and also from what we learned from Reserve Bank of India, like earlier we had our Chief Risk Officer at the cadre of Deputy General Manager. It was like they felt that the level of general manager will be required for chief risk officer to have a total control, and it is basically the relative positioning within the organization. And it is the new CRO is also an internal candidate who had been with us for quite some time, and also he had experience as chief risk officers in his earlier employments and all, and that's why it's an basically internal, some sort of rearrangement. Similarly, we have a few, superannuations which are expected in the, next 1 year or so, for which we have to go for, rearrangement, and, the responsibilities have to be, given for the next generation and things like that. So this is basically the feeling is that like the earlier it was sufficient for us to have a chief risk officer at the level of deputy general manager, and now it is getting repositioned as a general manager. That is the thing behind it.
This, I hope you'll appreciate the spirit of my next question. Your reappointment, sir, is also due. When do you expect endorsement coming on that from RBI?
The board has already sent the recommendation, and normally my actual date of completion of the current tenure is on 30th April. If you look into the earlier, almost I had gone through 3-4 extensions in the past. We usually get maybe 1 or 2 weeks before the end of the tenure. So probably we have another 4 to 5 weeks to wait.
So market should not be worried, right? You're reasonably confident that the extension will come through.
That's the hope, and we don't expect any major issue on.
Despite the fact that the regulator a couple of months ago had raised concerns, you think that that is something which is not something which could appoint your reappointment?
Yeah, this is not something which can be spoken directly in the live telecast. But what we have gone through this extension almost 3-4 times in the past, and we hope everything should be going through, and we are reasonably confident.
When we spoke last, sir, we were talking about your quarterly numbers, and you, in a sense, your comment that look, you would be taking growth and risk, and you would be balancing it. And for the quarter gone by, the growth was below industry average. Your outlook also indicated that at your base, your growth rate will be lower than the industry average. Are you looking at revisiting that? Because when I look at banks which have a balance sheet like yours, they are committing to us a growth rate which is in late teens and even 20% plus, while you're talking about a number which is early teens. Are you looking at revisiting your growth numbers which you shared with us after your quarterly numbers?
Basically, if you look into that, this particular questions I have been hearing for past many years at this phase of the interest rate cycle, at least 4-5 times in the past. So we have to take multiple factors into account, and the current growth rate definitely is yes. The systemic growth rate is around 16%. We also thought when we were discussing about the second quarter results, things should be firming up, and we should be even working for 15 to 18% growth rate for the current year. That was basically coming from the way around the same time last year, say calendar year 2022, the capacity utilization was much lower, but the things were getting better from the COVID lows, and the Ukraine war, oil price, and inflation and all were there. But things started moving in a good pace. We expected normally what we see in the line of activity where we are there, when the capacity utilization crosses 80%, people start talking about going for further investment, but actual investment start when the capacity utilization crosses about 85%. We were expecting those numbers will be coming towards the end of the current financial year, and we were very confident, but things somewhere got stuck at the pre-COVID level. In fact, even in the last policy statement, the capacity utilization is still at 74.5%, almost exactly at the same point things were there during the pre-COVID level. And you are hearing multiple reports on how things are moving. Another thing what we are seeing is that like many of our peers, they have also aggressively gone for portfolio buyout for the NBFC sector, which is also contributing for the growth, which we are not going. We are going organically. And we feel like particularly when also you have the deposit growth rate of the system is lower than the credit growth rate, you can't have credit growth rate at a sustainable level in the higher team. And so as we have told in the past, we will be balancing growth and risk. And in fact, in terms of the P&L profitability, return ratios like ROA and all, our third quarter has been one of the best quarters where we were able to absorb the entire RBI divergence in a single quarter and all. So our priority will be in protecting the P&L and the balance sheet stability more than just accelerating growth. The growth will automatically come maybe in the next few months when things normalizes. And we are not in a hurry. We are continuously watching the situation, and depending upon the need, we will be increasing it or do required changes for the growth as we move forward.
Sure. Could you just leave us with a number in terms of where you see your NIMs headed?
Basically, we had been, like say, expecting and sharing like our NIM range had been between 3.8 and 4.1 for the past 10-12 quarters, and in the same range. Actually, it expands when we get into the increasing interest rate scenario, and when the liability side gets repriced, it gets into the contraction mode. We are still seeing the margins and the almost reaching the like say the band of 3.8 to 4.1, as we had been guiding in the earlier result con call discussion.
Okay, Mr. Kamakodi, great to have you on the show. Thank you so much for taking the time out and speaking with us today on ET Now. Let's move sectors and let's talk about sugar, considering that's the sweet one, right? And the national food security comes first. That's the word coming in from the Food Secretary, Sanjeev Chopra. He explains the rationale behind the sugar exports cap, adds that they will continue to push for ethanol blending as well.
Exports we had last November of about 60 lakh tons, and the sugar production is estimated to go down by about 9 lakh tons during this season, from 395 what we had in the previous season to or 386 is what we're expecting of sucrose production. We would be seeing a diversion of about 50 lakh tons of sugar for ethanol, so roughly giving us about 336 lakh tons of sugar during this season. The national consumption is about 275 lakh tons, and we have already allowed exports of 60 lakh tons. So I think one can do the math. So as of now, there is no proposal for any further exports of sugar for the time being.
All right, now let's connect with the management of Balrampur Chini. Pramod Patwari, CFO of Balrampur Chini, joins us now. Pramod, good morning. Thank you for joining us. You know, sugar is one sector which is on everyone's radar, whether it is policymaker, Indian consumer, or stock market commentators. Before I get into specific of exports and ethanol demand, walk us through the big picture. Where sugar prices have been, why sugar prices are at a 7-month high, is it demand or is it pure supply imbalance?
Yeah, good morning, Nikunj. So as far as the international sugar prices are concerned, we are of the view that international prices are somehow decoupled with the domestic prices. The reason behind 6 to 7 years of international high sugar prices is there is some sort of physical tightness into the system in terms of gaps, availability gaps. Though overall there will be surplus at the global level, but in the interim period, as because the logistical issues are there in Brazil, there is some physical tightness. Domestic prices has not really moved up in last couple of years, though the cost has increased significantly in terms of cane price increase, lower yield, as well as lower recovery. Now, the big picture what you are mentioning of is the ethanol story. if my memory is serving me right, that last year we purchased around 370 to 375 lakh tons of sugar cane from the farmers. And if you apply a 350 rupees per quintal as an average rate, that translates into 1.3 lakh crores worth of sugar cane. As against this, if we take 27.5 million ton as the national consumption, and if we take an average sugar price of around 34 or 34 and a half, as because Maharashtra sells lower, it translates into an annual realization of around 90 to 95,000 crores. So the gap between 1 lakh 30 to 1 lakh 30,000 to 90 to 95,000 crores of rupees is being currently met by exports as well as ethanol. So last year, industry supplied almost 400 crores liter of ethanol. If you take an average price of around 55 rupees per liter, it translates into an 22,000 crores of revenue from the ethanol segment. So there lies the big picture.
When it comes to ethanol demand, do you think ethanol demand, while it's great that we are moving to green fuel and clean fuel, this in a sense is going to be indirectly fueling the sugar prices higher only? Because if sugarcane gets diverted for ethanol production, which is what sugar companies would be doing, that's why margins are higher and stability of business is higher, it could indirectly start impacting sugar prices.
But the sugar prices had not really moved up in the last couple of years. The first priority is obviously the sugar availability into the country for the domestic consumption. Next being the ethanol, and thereafter, if anything is left, that only can be exported. So we don't think that there is any price risk, in view of the continuous improvement in the ethanol.
Sugar exports are relaxed, which is what there seems to be a sense in the market. Is this something which will incrementally benefit all sugar companies, or it would be selectively for companies which have a refining capacity in and around port? Because in sugar, transportation is also a big cost which we tend to ignore.
So as far as the logistical issues or the infrastructure availability is concerned with respect to export, the big picture is if the surplus sugar moves out of the country, it doesn't matter whether it leaves from Uttar Pradesh or from Maharashtra. The availability of sugar at the national level comes down. That gives supports to the domestic prices.
But what happens to the profitability, Pramod, in this case? I mean, even if there are additional 1 million ton sugar exports are allowed, given the low quantum of last year's export, is it going to really aid profitability significantly for sugar companies and for you in specific?
So again, your question is with respect to export. I would like to comment by saying that government will take decision maybe at the end of March or in the month of April when they have a better visibility with respect to export, with respect to sugar production. As of now, the country's production is expected to be around 33.5 million ton, and on numerous occasions, government has made it very clear that they are comfortable with an closing inventory of around 2.5 months of consumption as of 30th of September. So last year we began with around 6 million ton of inventory. So maths can automatically be worked out.
You know, let's talk about ethanol then, because a concern for ethanol segment has been lower growth of ethanol prices. You've expanded your ethanol capacity, which could very well aid your top line growth. But given higher molasses prices, lower ethanol prices, just wanted to understand how profitability for purely ethanol is going to shape up for you.
So the ethanol prices are, there is no ambiguity with respect to ethanol prices. Ethanol prices are announced annually, once in a year. And last announcement had happened in the month of November, wherein a price raise was given. It is linked with the prices of sugarcane as well as the cost of production of sugar. However, having said that, we have now reached at a juncture where higher and higher diversion of sugar into ethanol is required, and which can only happen when there is a larger juice-based ethanol capacity. To incentivize ethanol producers to come forward with an additional capacity, what is required at this point in time is the more remunerative juice-based prices. And for that, we have represented to the government through our association to have a relook at the juice-based ethanol prices.
So if you have to talk about the sugar cycle in India for 2023, where do you think the cycle is headed?
Nikunj, in our view, the cyclicality has been significantly moderated in view of various evacuation measures available with the government as well as the industry. A significant portion of sugar is getting converted into ethanol. So this year, maybe around 4.5 million ton of sugar will get converted into ethanol. Last year, it was around 3.5. And the trajectory for next 2 years is between 5.5 to 6.5 or maybe 7 million. So in our view, the tag of cyclicality has been significantly moderated. Apart from the natural vagaries, we don't really see any other cyclicality reasons.
Last question, that the predictions for summer this year are not very encouraging. And if there is a El Nino impact, it will surely have an impact on monsoon distribution and rainfall. What happens in this year, in this case, if you have a hard summer and a poor monsoon?
By that time, the sugar season 22-23 will be over. As of now, we have a good amount of water reservoirs level. So maybe that may impact next year's sowing as well as the harvest. But that will normally impact the domestic Maharashtra and the Karnataka region.
Pramod, great to have you today on ET Now. Glad that you could take time out and speak with us.
Thank you.
Okay, that's the word coming in from Balrampur Chini. The stock, of course, after a big move yesterday, is currently lower, just mildly soft actually. For the market as well, we started off absolutely flat. From there, we've drifted just an inch or so lower, 44 points down in the red. 17,750 is where, the Nifty futures are. Reliance, that's a big drag today. That's down 1.25%. There's PVR, Indus Tower, Metropolis, and then Andani Enterprises as well, which is a big drag, 2.5% lower on that stock. On the flip side, FSL, Apollo Hospitals, SBI Cards, REC and Manappuram are the ones which are actually holding out within the broader end of the market. On that note, we're going to take a very quick break, but come right back. Lots more interviews lined up on the other side.
Strength index over here. This time when the RSI was almost at 65, 66 levels, the rupee first time hit the level of 83. Similar was the case in December, but this time the RSI had dropped down to almost levels of 58. And the third attempt was just very recently, last month, February, where the rupee had come back towards 83 odd mark. But this time again, the RSI had dropped a bit more lower for the rupee. This indicates that the rupee is going towards a trend where the asset is consolidating. But there's a higher chance that the rupee would probably come back towards levels of 81 and lower. The bigger breakdown could probably happen once this trend line gets broken. So this is a trend line which coincides almost at this 81 mark for the rupee. If the rupee breaks below this level, I would believe that there would be a sharp appreciation of at least $2 rupees over here, and we may probably come back towards levels of 79.5 as well. So this is what the charts for rupee is indicating, that the asset is consolidating as well. Probably a likelihood of breaking below that 81 mark and heading towards 79 as well.
Okay, interesting observation on the rupee. Naresh, L&T Finance, that's the chart buster for you.
So looking at L&T Finance holding with a little medium to longer term view, if you look at the last 1.5 to 2 years, the stock has made the same tops around that 95 to 97 mark. Now that's a huge inverted head and shoulders pattern, or you could call it a cup and handle pattern. Now the interesting thing over the last 3-4 months has been it has corrected, but every time it has corrected from 95, it has made a higher bottom. So the base has started shifting from 75, 80 to 85 to 88 levels now. Eventually, I would expect this to break that 95 mark, and once that happens, initial target price would be 110 to 125. So at current levels, preempting that move, accumulated current levels with a stop loss of 87, add more on the way up about 95, 98 zones with a target price of 110 to 125.
Right, let's talk stocks. Kunal, what about your trading ideas?
So I'll mix up a strategy a bit. First is a contra buy on Cipla. We indicated this buy yesterday as well. Classical, oversold nature of indicators for the stock at 880 odd mark. So target remains at 904, stop loss at 860. And the second would be a buy on Indian Hotels. We discussed the stock sub 300 levels. It's now moved closer to the 330 mark. So looks attractive for another 20 rupees on the upside. So 340, 45 could be an immediate target for Indian Hotels. Stop loss at 324.
Okay, Naresh, let's get in your top trades.
So two power names. First is a buy on IEX, stop loss of 147 and a target price of 170. The momentum continues here. Second is a buy on Tata Power on verge of a breakout about 210.12 and say 215. Setting up for that move. Stop loss at 207 and a target price of 240.
All of your top technical trades coming your way. Moving right on, time to recap some top fundamental stock calls.
Utility stocks have remained relatively better off in the last few months. And if you see the volume data points and the tariff part, there is a fair bit of stability. So we do think that names like NTPC, Power Grid are the ones which will provide some sort of a stability with a good dividend yield for those who are looking for a low risk ideas. At the same time, some of the companies which are providing the equipments to some of these utility companies, on the capex side, I think that is the only segment which is showing a lot of strength, and the order inflow for them continues as the capex cycle is moving. So I think we should focus upon capex. So the names like ABB, Siemens, Larsen, and also some of the power utilities in an environment where there is a slowdown and the overall market may not show much of resilience.
I think, in addition to Voltas, we would also buy a Crompton Consumer. The stock has corrected significantly, and it has had its fair share of problems, and they'll also benefit from some kind of consumer spend. Symphony is another stock which traditionally does well in any summer, and of course, while it is not really a summer issue, but I think some of these companies like Thomas Cook and Mahindra Holidays will benefit from the summer travel. So I think basically it is Voltas, Symphony, Crompton Consumer, and the hotel company.
On that note, let's take a very quick break. We're still just about mildly soft, so pretty much in line with what the rest of the global markets have been up to.
All right, let's get a move on then. Welcome back. Close to the lowest point of the trading day for the markets. We're down 1/3%. It's no great shakes on the downside either. In the broader markets, trying to see some recovery, but it's a mild one at that. Names like Adani Enterprises, Reliance Industries, heavyweights like ICICI Bank, or even TCS, ITC and Bajaj Finserv, they're all under a bit of pressure this morning. But let's find out how things are trending in the commodities universe. We've got Vinny here to walk us through just that. Vinny?
Good morning, and looking at the oil prices this morning seem to be in a bit of a subdued range, still below the $83 per barrel mark this Thursday morning. Mainly the Chinese consumer inflation data that has come in is reading weaker than expected. So that's an important factor that we're keeping an eye out on, keeping the oil prices a bit subdued. As well as, let's not forget, the hawkish Fed signals are something that is lingering on the oil prices since the last couple of days. Gold prices, they too have remained in the range this morning, somewhere around that $1,810 per ounce mark, slightly above that, but yes, in that range as well. And now what investors are waiting out for is the US jobs data, because that will be an important factor that everyone is keeping an eye on, because post this, everyone will be seeing how Fed is going to be taking in terms of the rate hikes coming in as well. The signal will be coming in from this US jobs data as well. Copper prices, they have fallen this morning. Yesterday, what they managed to close a bit on the high, but yes, they have given up those gains because dollar is actually at around the 3-month high levels as well. Now, obviously, the greenback price metal is more expensive to holders that are in other countries. So that is a factor for the copper prices. Do not forget that the easing supply disruptions in major copper producing countries also is something that was pressuring the copper prices previously. And nickel futures, they have continued to trade below the $24,000 per ton mark as well. These are the levels that we have not seen coming in since the early November 2022. Pressured by mainly persistent weak demand is something that is coming into play for the nickel prices. So keep an eye out on these commodities today. Mainly we'll be watching out for the US job data as well.
We will, quite a few data points there, but let's take a look at the February 2023 data rather of the Indian life insurance sector as well, where they have reported a muted 10% year-on-year growth in the retail APE segment. Vinny, what about the details there? How do you read into the data?
So absolutely, it is a muted growth, only 10.5%, like you mentioned, on a year-on-year basis in terms of the retail APE growth. Now, what is actually coming in is a very divergent play when you look at it in terms of private players as well as a public player, which is LIC. Different data is coming in. Now, look at the growth that we've seen for HDFC Life. They delivered a strong growth. Individual APE growth was around 26.7% on a year-on-year basis. Even ICICI Pru, they managed to see a good growth coming in because of the increase in ticket size is something that supported the growth for ICICI Prudential Life as well as Max Life as well. So Max Life also reported a bit of a muted growth, but around 6% growth on a year-on-year basis. Now, what I was talking in terms of the divergence, because LIC's individual APE growth, when you look at it, it's actually a decline this time of 3%, while the total AP for LIC also declined by 17.7%, which was below the expectation of what the street was expecting as well. So yes, mainly what saved ICICI Pru Max Life was the higher ticket size, the pre-bookings that we have seen for high ticket size because of the change in the policies that have come in the union budget. So because of that, we have been seeing an increase in terms of pre-bookings coming in for high ticket sizes, which is supporting ICICI Pru and Max Life. HDFC Life managed to see a strong growth.
Thanks very much, Vinny, for walking us through all of that data. Let's move right on then. Gokuldas Exports, that's a stock that we're tracking. It's under pressure. There has a 10% equity that changed hands in a block deal. Let's get in all those details of the block deal exclusively, and we've got Pankaj here with the details. Pankaj?
Well, as we told you in the morning that, one of the holders of the company has gone ahead and opened a book to sell 10% stake. And what we saw this morning is that 10% equity has changed hand across multiple deals. You can see at the bottom of your screen, Gokuldas is down 2%, 390, as we told you, was the floor price. So, the deal has gone through and Clearwater House has finally gone out and, sold their particular stake, Clear Wealth Consultancy. And when we talk about this deal, they own about 22% stake in the company, out of which now they have sold about 10% What we are picking up is that JM is the banker. That deal demand was particularly on the stronger side, and now we can pick up that a mix of or a bunch of FIs and DIs have gone ahead and bought this particular deal or have participated into this particular block that was available. Stock, of course, has way higher volumes than average, but that's because of the 10% equity that has changed hands and which was being managed by JM Financial.
Okay, stay with us because the other big buzzer is Sequent Scientific, the stock soaring after the company cancelled the acquisition of Tineta. What does this imply for the company?
So, once this acquisition came in, there was some concern as to how it should go through. It was a 3-month sort of a MOU that they had signed, and that expired on 7th of March. So, yesterday, they said that, they are not going ahead because the transaction did not materialize. As we told you, it was a MOU and not a transaction that went through. It was a MOU or a memorandum of understanding to go ahead for this transaction. Yes, there were some concerns between that. The numbers came in and, there were some concerns as far as margins, cash flow overall is concerned. And now with this transaction not going through, it's been taken on the positive side because since the acquisition, since the new management has come in, the stock has been beaten down, and really one of the concern was how flows come in, how margins recover. So a little bit of relief coming in. You can see volumes 6 million. There are hardly any volumes in this counter, and definitely this comes in as a relief. That transaction did not materialize, which expired on March 7th.
Thanks a lot for that. Now, Lalit Agrawal joins us, Chairman and Managing Director of VMAR. Let's take our conversation forward to understand that how real is the slowdown? Is it just a perceived slowdown, or this is a real slowdown which is there in the rural India? Mr. Agrawal, good morning. Thank you for joining us. When I speak to some of your peers, the sense we are getting is that there is a slowdown, and especially a rural slowdown, and everybody is feeling the heat, including value retailers like yours. Is it true?
I mean, definitely there is a concern, there is a pressure on the real consumer of Bharat, and those lower earning group member people who forms almost 70% of the population of India. They definitely have reeled under pressure of inflation, and their budgets, their household budgets has gone down. So I think there they are struggling, and that is what is causing a little bit of slowdown. And we are seeing those slowdown right from post-COVID environment. Because post-COVID, during COVID, they lost some of their income, but post-COVID also, they couldn't regain back their income, as well as the kind of inflation which ate into their pocket. And that's what is affecting those kind of slowdown. But yeah, gradually, quarter on quarter, month on month, we are seeing betterment on those side. It is also an outcome of the feel-good factor, which we call as the feel-good that the consumer has in terms of their forward earning capabilities and earning abilities, and the risk that they see in future, whether in terms of the Ukraine war or in terms of the recession coming in. So there was a lot of news in the media which make them a little more conscious on their spending, and that's what we've seen. But period of month on month, we are seeing that getting improved. So the rate of such slowdown is going away.
So I'll split my next question in two parts. On an aggregate basis, if you have to compare the current demand with pre-COVID, where does it stand? And which are the categories which have not recovered in a meaningful manner from the pre-COVID slump?
See, largely, I mean, we have last quarter, we reported almost 11% degrowth from the pre-COVID times, from the same store, like-for-like stores perspective is concerned. So I mean, that also, I think incrementally is getting better, but still there's not, we are not seeing a growth over the pre-COVID level. And categories, primarily categories of the apparel, because that's the biggest segment that we sell, and the fashion segment. So that we see there is some kind of degrowth which has happened there, especially in men's apparel and the women's apparel. The kids apparel continues to be where it is because people didn't stop spending on the kids apparel, but especially on the men's and the women's, we saw a little bit of degrowth.
Mr. Agarwal, morning. What about the outlook in terms of some of the low margin products? Is that what you're seeing traction in? Is that a bit of a concern in terms of what your margin recovery could look like as well? We have seen yarn prices as well correct, and your margins have managed to sharply correct. So do you think that the low margin products seeing traction could be a bit of a concern?
So I would not say low margin. I would say, so there are different kind of models. So what happened if you understand the whole journey, because of the cotton yarn prices going up, most of the apparel manufacturers and brands and retailers, they took the price hike, and we also took a very steep price hike, almost one of the steepest price hike that we ever took in our 20-year journey. So which customer didn't like and consumer didn't appreciate. So we got the message in the last season, and we corrected our prices. We rolled back those prices now, and now we are seeing even the yarn prices coming down, but still not down to those levels. Still, from those base level, it is still 40% up. So the yarn prices are still up, not 70%, but 40%. But our prices, we have rolled back. We have done some innovation, some blending of the product, so that we are able to provide consumers a similar price point product. So especially lower price point products are getting much more attention and much more attraction. So we are seeing very good consumer coming back in the lower price point product, but still on the higher price point product, we are seeing a little bit of concern and stress. So that's where consumer are not spending on the higher price point product, and that is very logical because of their basket.
And I understand that you intend to take online at about 20% of your sales in the next 24 to 36 months. What's the game plan, and do you think it'll be margin accretive?
I mean, see, we don't see very differently in the margin perspective, because for us, almost all customers and all formats and all channels are equal, and we would have similar pricing in most of the channels. So I don't think margin will create a big impact on any of those. But yeah, largely it is all about the bent or the channel which the consumer are now preferring, or leapfrogging we call. So how do we try and take this as an opportunity and try and see whether our consumer base, which is the real Bharat consumer, are they adopting those digitalization? Because we have always believed that, because they buy 2 times a year clothes, they don't want to look at a photograph and buy their needs, and they do the investment. But yeah, things are changing. Things are changing with the youngsters and the youth. So we believe over the next 3 to 4 years, there will be a lot of changes which will come in. And if we can grab onto those opportunities, that's how we are getting prepared ourselves through the new acquisition that we did of LimeRoad.
Question is, sir, if there is a slowdown, value retail should do well. But it's the reverse. This time around, luxury is doing very well. Mid-market is doing reasonably well. But value retailing, whether it is V-Mart or D-Mart, has taken the highest hit.
I mean, it's a K graph economy which is getting built up, and we are seeing those K becoming more steeper and steeper post-COVID. And that's what it affected into people who are earning and business houses or businessmen or rich people, which we call the top 15-20% of the demography. And they are definitely have got benefited, whether they are professionals or whether they are doing their own businesses or running industries or in stock market or property market. So most of them have their incomes have gone up and they are seeing a betterment, and they didn't spend too much during COVID. So all of those revenge shopping and all of those revenge tourism came into effect, and that's what we are seeing in malls and airports and the tourist places. So I think on the other side, if you look at the poor people and the people who used to struggle, for them, this COVID period of 18 months, they lost almost 6 months of salary or 6 months of their income, monthly income. So that impact caused the pain, and post that the inflation also got into their pocket. So I think combine the two and look at those small town consumer or those consumer who earn between 20 to 30,000 rupees. And we spoke to a lot of consumers, and we realized that these consumers were struggling to build onto the saving of 2,000-3,000 that they used to do earlier, and now they are on a little bit of debt. So that is why they want to reduce their discretionary spend, and that is what is happening in this particular segment, which is the below the line of the demography.
We are in for a hard summer and let's say poor monsoon this year. Will this stress in the rural economy only multiply? Because that's my other worry, that this year, at least so far, the weather patterns have been quite erratic.
I mean, see, we on the other side, I say that in the last 2 years, the monsoon has been so good and the crop has been so good, the crop yield has been good, the MSPs has been good, and still the rural has a pressure. So I don't know how much it is directly going to be affected, but yeah, I think it is more about the feel good factor, which I mentioned. And if that goes better, people start spending and people also start borrowing if they want to, because they will not stop their spending. So it's all about feel good factor, and I feel as the feel good factor of India is bettering, our Bharat is bettering, the way the Prime Minister or the nation is speaking, the government is speaking about it, and the infra investment which is coming in. And I think all of those will improve the economy. Even the election period brings in a lot of money in the economy. So that also should help the economy to a greater extent in the coming year.
Give me a sub-trend. When I say a sub-trend, which particular geography, including your acquisitions, growth is above COVID? Which are the categories which you represent, the growth is not recovering? Give me a sub-trend so that we know that how the geographical distribution is moving.
So on the geographical sub-trend, if I look at it, especially our core belt of UP and Bihar, we have seen the pressure the most. And that is what we also, when we speak to our peer group people, FMCG companies, even there they've experienced it a little more steep. So the pressure on the degrowth has been more in the UP and Bihar zone. But otherwise, in the other northern territory, as well as the territories of southern India and eastern India, we have seen a little better perspective on the percentage of degrowth that has happened on a like-for-like store basis. But otherwise, I think, as I said about the categories, I've already told you that the major hit the head of the family is taking, so that he doesn't spend too much. They are spending for their kids. They are spending, especially women are also curbing on the spending, but still they are spending better than men. But men is spending a little lesser than everyone else in that particular zone.
All right. Thank you so much, Mr. Agarwal, for joining in and giving us a deeper understanding of how the business is shaping up. Time for a quick break. Stay with us. Lots more lined up when we return.